Hi everyone, it's Monday the 8th of June. Kiwibank has raised its fixed mortgages, joining the BNZ, ASB and TSB. But banks are doing it hard in the recession, right? Let's look. In the 6 months to March, ANZ made a $494 million profit. The BNZ, slightly less, $400 million, and Westpac, more than $200 million. Pretty healthy profits in just 6 months, although all down slightly on the year before. And now they're putting interest rates up, despite the Reserve Bank setting the official cash rate at an all-time low. In a moment, we ask Bernard Hickey, is now the time for you to fix? But remember, once you fix, if you break your mortgage, banks can cane you. Now, this is being done reasonably, according to the Commerce Commission, but many of you don't feel that way at all. So many of you have contacted us complaining about high break fees. We decided to pick two examples. Here's Helen Vaughan.
Okay, so this is the house that we plumped for in the end.
Neil Winfield has just downsized to this house in the outskirts of Hamilton. He lost his job, and with a wife and two teenage daughters to look after, he was forced to break his mortgage and sell his previous home. The
payments were very difficult to make on what I was having coming in at the time, which was nothing.
The break fee on his $320,000 mortgage was $12,000.
I thought it was pretty rotten, to be honest with you. Because, you know, you're with the bank and you expect them to help you.
Denise Grobbelaar owns this small property with her husband. They want to break the interest rate on their $285,000 mortgage 4 months early to take advantage of lower interest rates. The break fee for them is nearly $6,000.
If the interest rate was lower, you'd probably find that we could be saving about $150, maybe up to $200 per week, which would make a huge difference.
Denise wants to know how the bank works it out. Think of these blocks as 3% each. Your interest rate was at 9%, but now you want to pay 6%. The 3% off the top includes the bank's profits and costs, so they'll charge you for that with a break fee. If you want to work it out yourself, here's the formula. Not quite straightforward.
It is a legal contract. You signed it, you've taken it, you're now wanting to break it, and there is a cost. And to the bank, they don't want to incur that penalty.
Homeowners we spoke to either didn't know there was a fee or couldn't understand it.
We knew there was a fee, but how much we didn't know.
I've looked through my paperwork and agreement and I can't actually find the calculation, or I can't find the term where it says that you will be charged this if you decide to come down on a lower fee.
Another complaint was a lack of independent advice once people find themselves in trouble.
I'm not too sure that there is a place where we could actually go to and say, you know, we need help, explain this to us.
Nobody really. Just going back to the bank.
Mortgage broker John Urkla agrees that apart from the banks, there's no objective advice out there.
People who are independent actually getting some information into the marketplace in a form that people can actually understand, and that is absolutely required.
Where can people actually get advice on this?
Well, you can come to us, but
you're owned by a bank.
That's absolutely, well, partly owned by a bank, but the simple reality is they need to ask questions. They need to be...
Who do they ask?
They've got to ask the banker. Tell me what this is all about. Please tell me. Please explain to me. And if they can't explain what the situation is, then I'd probably put it to you that that bank shouldn't have their business.
So what should you do? His advice is to know what you're getting into and what it costs to get out. As for our people, Neil is no better off and is still struggling to make his repayments.
Doing longer hours, doing extra work. Yeah. Help from my daughter, who's working as well.
And Denise is thinking about selling up.
I just feel it's not worth us keeping a mortgage of that size. We might be better off just renting.
Helen Vaughan reporting. So when you fix, do so with both eyes wide open. There are times, Bernard Hickey from interest.co.nz, when in fact it's really crappy to fix. I've just been looking at your website. You suggest now is not a bad time to fix. Why?
Because interest rates, at least long-term ones, are rising. And because all around the world, governments are borrowing heavily, and that's pushing up long-term interest rates. And we're seeing that here. As you pointed out at the start, quite a few of the banks have pushed up their longer-term interest rates in the last couple of weeks because those markets are watching Barack Obama overseas and Bill English here rather than Alan Bollard.
OK, so Barack Obama and Bill English are borrowing money in the same way that people taking out a mortgage are borrowing money. And I guess, in short, they're competing for the same money, which forces interest rates up, right?
That's the drawback of heavy deficit spending. There's only a certain pool of money, and unless the government or the Reserve Bank's willing to print it, and we're not seeing that here in New Zealand yet, then that will push up long-term interest rates. And what we're saying is, if you are interested in fixing, particularly longer term, now's not a bad idea to look at it because interest rates are rising, particularly at that long-term end, but not at the short term.
Now, this is confusing for people because they think interest rates rise when times are good as a method to control inflation. But interest rates are rising at the moment and times aren't good. So this is a kind of double whammy, isn't it?
That's right. There is no way around it. When you've borrowed too much and you've spent too much, the way out of it is not to borrow more and spend more. It's actually to spend less and to save more. And this is the problem. And this is why interest rates are rising, because all around the world, investors are seeing governments try to borrow and spend their way out of a problem created by too much borrowing and spending. And that's why interest rates are rising. And that's something we should all care about here if you've got a mortgage or even if you're saving, because one of the interesting things, this week the Reserve Bank may cut the official cash rate. That's the overnight rate.
It's 2.5% at the moment?
Yep. Could drop to 2.25%. But the good thing for savers, and there's lots of them, they're not going to see their term deposit rates fall because the banks can't afford to cut their rates.
OK, so even if the Reserve Bank drops the OCR even further to a new all-time low, you still don't see those long-term fixed mortgage rates coming down?
No. In fact, if anything, they could rise. And that's what we've seen this week. In fact, just in the last couple of hours, ANZ National have added to that list and have put up their longer-term mortgage rates. And we've also seen some term deposit rates, some savings rates, rise as well. This is all about this competition for money on global markets and here from the governments.
OK, so now is not a bad time to fix if you're looking long-term and you just want to play it safe.
That's right, but you're right. Eyes wide open, because if interest rates drop again in the next couple of years, which I don't think is that likely, then you could be worried again about missing out on those lower interest rates.
Bernard Hickey, you can read all about this on Bernard's website, which is interest.co.nz. Thanks, Bernard. Really appreciate your time as always.